Today we will be talking about 1031 exchange, how real estate investors legally defer taxes and the mistakes that blow the whole deal. A lot of real estate investors hear 1031 exchange and think it's some magic loophole where you never pay tax again. And honestly, that's where people get themselves into trouble. So today I want to break this down in a really simple way because after our last conversation about depreciation recapture and taxes when you sell a property, the next logical question becomes, okay, so how do investors avoid getting crushed by taxes when they sell? And one of the biggest strategies is the 1031 exchange. So now first, let's clear up one very important thing. A 1031 exchange does not eliminate taxes, it defers them. And this is a huge difference. What you're basically doing is telling the IRS, I'm not cashing out, I'm reinvesting into another investment property. So instead of paying capital gain taxes and depreciation recapture immediately, you roll those gains into another property and push the taxes into the future. And this can be massive because imagine someone sells a rental property and they have a $300,000 gain between federal tax, state tax, depreciation recapture. They could easily lose a very large chunk of that money to taxes immediately. But with a properly structured 1031 exchange, they may be able to keep that money working for them instead of sending it to the IRS right now. That's why investors use this strategy to keep scaling. They go from a duplex to a fourplex to a bigger building to a commercial property while continuing deferring taxes along the way. But here is the part most people don't realize. 1031 exchanges are extremely strict. This is not of those I will figure out it later or along the way situation. The IRS gives you very specific deadlines, and if you miss them by even one day, the entire exchange can fail. And I have seen people lose tens of thousands of dollars because they don't understand the rules. So let's talk about the biggest mistake. The first major mistake is touching the money. This is probably the fastest way to destroy your 1031 exchange. If the proceeds from the sale hit your personal bank account, even for a moment, the IRS can treat it as a taxable sale. So that's why you need a qualified intermediary involved before the closing happens, not after, before. The intermediary holds the funds during the exchange process, so you never technically take possession of the money. Another huge mistake is missing the timelines, and these timelines are brutal. You have exactly 45 days from the sale of your old property to identify replacement property. Not think about it, not casually browse Zillow, actually identify them formally. And then you have another 180 days to close on the new property. And the clock starts immediately after the sales closes, not when you find the property, not when you feel ready, and not when the lender gets back to you 3 weeks later, immediately. And honestly, this is where a lot of exchanges fail. People sell first and then start looking around casually for deals. This is backward. Ideally, you should already know what you want to buy before you even sell the original property. Another mistake people make is thinking they can use the leftover cash personally. Let's say you sell for $1 million and only reinvest $800,000. That leftover of $200,000 is generally taxable. That's called boot. Same thing if your debt increases significantly in a new deal. A lot of investors don't realize that partial exchanges can still create taxable income. And another big misconception, the strategy is not only for swapping one rental house for another rental house. The rules are actually broader than many people realize. You can exchange many types of investment real estate for other investment real estate. Residential rentals into commercial into multifamily, vacant land into rental property, but personal residences generally do not qualify. And vacation homes get tricky too unless they are structured properly as investment property. Now, here is something important I want people to understand emotionally too. A lot of investors work very hard to build equity for years. Then they sell a property without planning and suddenly realize a massive portion is going to taxes. That can completely change retirement plans, cash flow goals, and future investing opportunities. And the frustrating part is many of those taxes could have been deferred with proper planning before the sales happen. Because with tax planning, timing matters a lot. Once the transaction is already done, any strategy disappears. That's why I always say the best tax saving happens before the deal closes, not during the tax season when everyone trying to clean up after the fact. And one more thing before we finish today, a 1031 exchange is not something you want to do it yourself from random internet posts. There are too many moving pieces. Your CPA, qualifying intermediate, lender, attorney, and realtor should all be aligned before the sales happen. That coordination is what protects the exchange. So if you're thinking about selling investment property in the next year or two, this is something you should absolutely plan for early. If you want help understanding whether 1031 exchange makes sense for your situation, or how much tax exposure you might actually have when you sell, please reach out to us. Because sometimes one conversation before the sale can save an investor an enormous amount of taxes later. And as always, I'll put together a free checklist of the most common 1031 exchange mistakes that investors make. So if you want them, just comment 1031 and we will send it over. That's all for today. Share with the fellow real estate investor if you think they will benefit, and I will see you next week.